Never underestimate the power of hate. When you have a company that's been tarnished with a stock that's really and truly despised, you know what? You can catch some incredible gains once that company brings in new management and start turning things around. Why? Because nobody wants to believe the turnaround is real. The hatred is just too ingrained. And that gives you a fabulous window to do some buying after the numbers have started to improve, but before Wall Street has been forced to acknowledge the change and catch up to the future. Case in point, SandRidge Energy, SD. Boy, this is a long time we haven't talked about this one. This is a speculative $3.1 billion oil and gas company operating in the mid-continent region, mainly the Mississippian play that's in Oklahoma and Kansas. Oh boy, this is a company that's reviled by most of Wall Street. SandRidge is now former CEO Tom Ward. Well, he used to be a guest a lot on the show. He practically ran the company into the ground. He was an undisciplined empire builder, piled up a huge amount of debt. Worse, he couldn't manage expectations, consistently over-promising and then failing to deliver. Before the commodity collapse in 2008, this was a $67 stock. Then it crashed down to the single digits, and like so many other domestic oil plays, SandRidge, it's pretty amazing when I looked at it. Unlike all these others, man, it just didn't bounce back. Right now, it's still trading $6.48. Now, I actually think Tom Ward's a great guy. But what do I say at the top of the show? This isn't about making friends. It's about making money. And ever since SandRidge shook up its board of directors last March, then replaced Ward with James Bennett as CEO in June, Bennett has done a remarkable job of breathing new life into this company. Since Bennett took over, SandRidge has delivered 3 consecutive quarters where it beat the estimates and raised guidance. Not only that, but he sold off non-core assets in order to clean up the balance sheet, while also focusing like a laser on drilling only in the most productive parts of the company's acreage. Bennett's got a private equity background, which means he thinks like an investor, exactly what this company now needs. On top of that, SandRidge's directors and officers now own about 10% of the company, and their compensation is tied directly to beating the earnings forecasts. I wish every company could be run that way. Wouldn't our job be easy? In short, this is a whole new SandRidge. Yet thanks to the power of hate, the stock isn't getting anywhere near the respect it deserves, which is where the buying opportunity comes. Because make no mistake about it, SandRidge is still detested by the Wall Street promotion machine. It has the fewest buy ratings of any company in the space. 3 buys, 17 holds, 5 sells. Did you ever think those would be right? Does that make sense to you? The analyst community simply loathes the stock. The reason? SandRidge was red hot when it came public in 2006, and almost every oil and gas analyst had a buy rating on the darn thing when it started falling from $70 down to the single digits. Yeah, they got some scrambled eggs in their faces. Throw in all the damage the former CEO did to the company's credibility, and you can understand why the analysts are reluctant to get positive about this one. Hey, you know what? Short position, 11.4%. But here's the thing. SandRidge's new CEO, Bennett, has been running the show for 10 months now, and I think he's done an incredible job. I think the analysts will be forced to raise their estimates and ultimately upgrade the stock, even if they have to be dragged kicking and screaming. And, you know, we've seen that before. Now, I'm not the only one who noticed the changes, and this is really important because sometimes there's people I listen to, and I want you to do what they do because they've done so much work. Leon Cooperman of Omega Advisors, who happens to be one of the best stock pickers I've ever met in my life, he got behind this one at CNBC's Delivering Alpha conference last summer. SandRidge was trading just above 5. And last month, he reiterated his position right here on our network. He talks on Scott Wapner's great show. He thinks the stock can easily go to 10. When nearly all the analysts dislike a stock, but Lee Cooperman, the research director when I worked at Goldman Sachs, is pounding the table saying it's a buy, I go with Cooperman. You should too. When you look at the numbers, you can see that new management really is doing something right here. Last month, SandRidge had its annual analyst day, and the company gave some pretty bullish forecasts, predicting over 20% annual production growth over the next 3 years, 30% plus growth in earnings before interest, taxes, depreciation, and amortization, even as the company's capital expenditures should remain flat over that same period. Most of the analysts simply don't believe SandRidge can hit these numbers because it's got that tarnished history, checkered. Me, I bet SandRidge is being conservative. Bennett knows he can't afford to disappoint, and I mean that literally since his compensation is directly tied to beating the numbers. Plus, so far, the guy's got a stellar track record that's just being ignored. Like I told you earlier, since Bennett took over, he's delivered 3 straight beat and raised quarters. He's been able to do that because SandRidge has much better visibility than it used to. The needle mover for this company is the Mississippian play. You can Google it. You'll see exactly where it is. They have 1.8 million acres in this play. A couple of years ago, they drilled 30 wells in the Mississippi, and Tom Ward, the old CEO, came out and hyped the results to high heaven. The analysts took him at his word, and they got burned as the additional wells weren't as strong. Now let's fast forward to today, though. SandRidge has drilled 1,100 wells in the Mississippi. They know much more about how much oil they're sitting on and where the oil can be found. They get at it much better. Hey, that's in part because the company's got cutting-edge seismic technology, pinpoint the areas with the most crude. You know, we've heard that from Core Labs, which is one of my favorites. You see that stock lately? Thanks to this analysis, SandRidge has been able to pare down its focus to 670,000 core acres, which has allowed the company to drill far fewer bad wells and more great ones. By the way, one of the reasons I trust management's new growth forecast is that they waited nearly a year to collect all of this data before even giving any guidance. This is not the sloppy SandRidge of old that Wall Street loves to hate. It's a new SandRidge that's disciplined and consistent. The new SandRidge has cut costs aggressively, sold off non-core assets, including Gulf of Mexico holdings for $1.1 billion earlier this year. It's focused on capital spending on a smaller area. Thanks to this improved execution, we can now focus on what's always been terrific about SandRidge, the company's incredible assets. Just in their core Mississippian acreage, the area that represents the oily sweet spot, SandRidge has 10 years' worth of drilling inventory. That's just from conventional drilling, top layer of the Mississippian. They've been running tests on the lower layers, and if you factor them in, we could be talking about 20 years of drilling inventory. Last month, management said they have 4,500 drilling locations, up from 3,000 a year ago, a figure that would double the number of wells this company has, which is why I think the stock is just way too cheap. And I'm not even factoring in higher oil prices. I'm just focusing on production growth. You know what? The $6 stock, I think it'd be worth anywhere from 10 to 15 bucks. Now, many analysts are concerned about the company's cash position. They worry about the company won't have enough money to fund its capital expenditure budget in the coming years. Frequent problem with some of these high-rolling oil and gas companies, but this one I'm not saying is high-rolling anymore. That's why I think the fears are overdone. SandRidge sold its Permian Basin assets for $2.6 billion early last year to pay down debt, something I didn't wish they had done, but they had to. But I now believe we'll have no trouble generating enough money through growing cash flows and conventional reserve-based borrowings for this one to continue its drilling program. Here's the bottom line. SandRidge SD is so hated by Wall Street that the analysts can't see this incredible turnaround even when it's right in front of their faces. It's a risky stock, only worth buying for speculation. But if SandRidge's new management keeps on delivering, then in a year or two, this stock won't be speculative at all. Frankly, you know what this one feels like to me? The term we caught in Rite Aid, symbol RAD. The best percentage gains can be had right now if you're patient. Once the darn thing starts being loved, that's when we can skedaddle. Don't move. Lightning round is next.